Welcome. I'm Tom Schmidt. I'm one of the founders of Ticker Tape Investments, and we're here to talk about how to allocate your investments across different accounts. I'm going to jump right into it and start with the key takeaways from tonight's presentation. Number one is always roll over your 401k into a self-directed IRA when you switch jobs. If you still have a 401k from a prior employer, please switch it quickly, because you're paying fees you shouldn't be paying, and you can take advantage of more investment opportunities. Number two, always use self-directed IRAs and Roths instead of the normal way of having it at Fidelity or Schwab or wherever, because you can take advantage of more opportunities. Third, and this is kind of the focus of tonight's show, is to use your Roth IRA for your high return investments. We'll talk about that in more detail. Make sure you keep your depreciating assets out of your IRAs. You don't want to have tax losses occurring in your IRAs where you can't take advantage of those losses against your income. And then you want to use your taxable accounts in a strategic manner to make sure you're taking advantage of flexibility and using them to harvest tax losses. The title of tonight's show is How to Allocate Investments Across Your Various Accounts, whether it be 401ks, IRAs, Roths, or standard accounts. Like I said, I'm Tom Schmidt, one of the founders of Ticker Tape Investments. To start out, just so we know what we're talking about, I'm going to focus on 4 types of investment accounts, but then also talk about outside of an actual account would be the 5th way, is where maybe you just own a real estate investment in your own name. But the 4 main ones are a 401k, which you should only have if you're currently employed by a company that has a 401k plan. Otherwise, you should have turned all your 401ks into IRAs, preferably Roth IRAs in most cases, and preferably self-directed. Secondly, there are traditional IRAs. These are the ones where you pay tax, you don't pay tax before you put the money in, but when you take the money out at the end of the day, you pay tax on 100% of your withdrawals. So not only do you pay tax in retirement on the gains that you make, but also on the money you put in originally. The Roth is the opposite. You pay your income tax this year before you put the money in the Roth, but then all of your gains when you take the money out are tax-free. And then 4th is sort of a standard brokerage account. By that I mean, a trading account at Schwab or Fidelity where you can purchase publicly traded stocks, mutual funds, etc. And then of course there's the 5th way, where an asset or an investment is not actually in an account, you just own it in your own name. So one of the big takeaways I want you to have is, if you don't already have self-directed IRAs, go get them. In fact, there's really no reason why you should keep any non-self-directed IRAs, right? Because number one, chances are you're paying fees anyway. Number two, it limits the types of investments that you can take advantage of in that IRA account. So Rita and I are both big believers in self-directed IRAs and even Roth IRAs. It lets you get access to private equity deals that you otherwise could not hold in your IRA accounts. Many of you have heard me talk about one of my favorite stories is Peter Thiel, and the fact that he has over $5 billion sitting in his Roth IRA. That means he can withdraw that money at any time tax-free. How did he get there? I'll tell you a secret. It wasn't with mutual funds and bonds, right? He was investing in early stage companies, including, of course, PayPal and Facebook and the like. I'm sure Palantir as well, that appreciated over time at a multiple of his investment. That's where you want to be making those high return investments, is in your Roth. Please, for the love of Pete, if you own a mutual fund or a bond of any kind in any Roth account, please sell it, buy high risk, high return. Like, that's the place to put that portion of your portfolio. Whether if for you that's large cap growth stocks, put those there. You shouldn't be owning things like, Apple and Nvidia, or maybe Apple's okay, but not Nvidia in your traditional Roth or in your standard brokerage account. Those high return deals, your longer term bets with big returns, should be in your Roth. Now, I got to make a cautionary point here. If you're not familiar with something called unrelated business income tax, UBIT, you got to make sure you understand that before you make an investment in your Roth IRA. If you, for instance, invest in a multifamily property in an IRA account, either Roth or traditional, and that real estate deal is leveraged, in other words, they're borrowing money to buy assets, you're going to end up paying tax out of your Roth or traditional IRA principal. In other words, you can't pay it on your own. Money's got to come out of your account, which can be a problem if you don't have liquidity. An easy rule that you don't have to worry about this is if you're investing in C Corp. So like we had one of our investors is converting to a self-directed Roth IRA, and they're going to invest in the utility rescue deal in that account. Well, they don't have to worry about UBIT because utility rescue is a C Corp. What you want to watch out for is things like limited partnerships and LLCs. If they are earning business income, particularly from assets that they've leveraged, it can create tax liability for you. If you have questions about that, we could do an entire different call on that topic. So reach out to us and we can answer. I mentioned this before, very important. I have been guilty of this twice in my life. Don't leave money in your former employer's 401k plan. Convert it to a self-directed or Roth IRA and invest it, use it to invest some of your assets in private equity. Reasons include limited investment opportunities, high fees, restrictions on what you can do with the money, etc. It's very easy to convert it to a self-directed IRA. It's also a good time to look at it and say, hey, should I take advantage and convert my traditional 401k into a Roth IRA? So look into those options. There can be really good tax and other benefits from putting it into a Roth. And it's a great way to get access to private equity investments is through that self-directed account. Again, part of the punchline of this presentation is, where do you want to put your high return investments? The answer is the Roth almost always. Certainly your investments that are going to create short-term tax benefits do not go in a retirement account, not in your 401k, not in your Roth, not in your traditional IRA. You want those in your standard brokerage accounts, or like a real estate investment, maybe it isn't technically in an account, it's just in your name, because you want those to flow straight to your tax return to help you shelter your active income. And if you have challenges trying to figure out how do I use these passive losses to shield my active income, that's another thing we can help you with. Give Rita a shout. We're happy to talk about that. Now, if you are investing in private deals in early stage companies where you're expecting 3 times, 5 times, 10 times your money on a return, that's the perfect situation to put them into the Roth IRA, because then you end up like Peter Thiel with a bunch of money in that Roth account that you can take out at any time tax-free. I like to tell this quick story about my parents, because I think when I heard things like, oh, you don't want to have to pay tax when you take it out, it didn't really resonate with me. But I watched my parents say things like, hey, I would go buy a new car and I would pay cash for it, but I can't because I would have to take the money out of my IRA account and I would have to pay taxes on the money. So if I wanted to go buy a $50,000 car, I'd have to withdraw like $75,000, pay $25,000 in tax that I otherwise wouldn't pay to get the 50 grand to buy the car. And so literally my parents, who had all the money they could ever want, they didn't need any money, but they would make buying decisions and decline to purchase things or take trips or spend money that they had plenty of money, but it was because they were afraid to pay tax. So if they had done a better job of shifting more of their assets into their Roth IRA, then they could just withdraw 50 grand tax-free from the Roth and buy the car. But unfortunately, they didn't have enough of their assets in those tax-protected accounts to allow them to do that. And so it's more than just, hey, you don't have to pay tax on it. It will help you have more flexibility in retirement. Where not to put certain investments, the obvious one is anything with depreciation, like real estate properties with buildings that are going to depreciate, and show short-term losses on their tax return. You want to be able to capture those losses on your tax return, not park that tax loss into an IRA account that you won't get the benefit for years, right? Once upon a time, we ran a tour business that had a bunch of buses, businesses like that, maybe mining companies that have a lot of equipment. If you can get into a limited partnership on something like that, where you have significant deductions, sometimes oil and gas deals have a lot of immediate depreciation. You would not want to put an investment like that in an IRA or a tax deferred account, because you want to capture that tax loss immediately. What else? Watch out for leveraged real estate deals that could create UBIT liability. So again, if you're investing in multifamily properties that are borrowing money to buy the property, put those outside of your IRAs in a regular traditional sort of account. What else? That's it for that topic. Then we get to allocation. So again, everybody needs some bonds, some safer investments. Those can go, this slide says traditional or Roth, and technically that's true, but I would put my safer, lower return focused stuff in my traditional IRA. You want that slow and steady. You want it to be protected against asset value declines. So your lower risk, lower return stuff goes in your traditional IRA. Your growth stocks, your private equity deals, especially early stage things that you expect to become a multiple of the current value, anything like crypto, high return investments would go into your Roth. By the way, things like gold coins, which I encourage everybody to have some physical gold as well, those can go in your traditional IRA. I know gold's been outperforming its historical curves lately and may continue to do so for some period of time, but it's still not going to be the upside like a pre-IPO deal or an early stage deal or something like that. And then last, your taxable and brokerage accounts. Those are best for dividend stocks, short-term trading, and particularly loss harvesting strategies. So if you're investing in things that are going to get you a tax savings, make sure you put them in those non-tax deferred accounts. Roths, so you may have seen us give a little presentation about how the Roth may not save you any more money than a traditional IRA. Certainly if your tax rate today is the same as your tax rate is going to be in retirement, a Roth and a traditional IRA should be about equal in terms of tax benefit. You can watch the other presentation to hear about why. But the Roth does offer some other perks that a traditional IRA does not. Number one, it does not have required minimum distributions. Again, those drove my father crazy. He had to take money out and pay tax on it that he didn't really want to take. And so you don't have those if you have more money in your Roth. Number two, and this is important for some people, you can actually, you know how you can take an early withdrawal from your IRA, but not only do you have to pay a penalty, but you have to pay tax on the money when you withdraw from a traditional IRA. Your Roth, if something went wrong and you needed access to the money, you can withdraw it, the principal anyway, without any taxes being owed, even if you're not at retirement age. And then last, this should be a key function of your estate plan, that whatever's left over in your Roth IRA at the time of your death stays in a Roth and can pass to your kids. So the excess money that you don't need to live on in retirement, flow that into your Roth, because you won't have those required minimum distributions. You can just leave the money in that Roth account and let it pass to your heirs. We've kind of hit on this already, but remember, you can use those traditional accounts for liquidity, flexibility, and tax planning, right? Get your depreciation benefits in a traditional account so that you can take those tax losses on your tax return this year. So back to the key takeaway slide. Number one, always roll over your 401k into a self-directed IRA when you switch jobs. If you have one from an old job, please, please, please either do it yourself or call Rita. She'll help you get it transferred over. We believe you should always use self-directed IRAs and Roths. You can still buy any publicly traded stock, any ETF, any mutual fund in those self-directed IRAs, but it gives you a lot more flexibility. And most Americans, you may have seen our presentation, you guys probably don't have enough invested in private equity deals. This is your path to be able to right that ship a little bit and get your allocations in better shape. You can use your Roth for your high return investments, your traditional account for your lower return and tax depreciating investments. And then last, make sure you have a tax strategy that's using these different accounts, and particularly your taxable accounts, for flexibility and to capture tax losses for your benefit. Last, kind of a teaser for future calls, ask us about backdoor Roth conversions for high earners. Many people are limited in how much they can put into a Roth. Guys much smarter than us have come up with the mega backdoor strategy and the backdoor Roth conversion that allows you to put a larger amount into a Roth by converting a standard retirement account into a Roth, as opposed to just contributing a certain amount each year. And then also, we're happy to talk about how to use Roth IRAs for preserving generational wealth and for estate planning. That's all we have for tonight. Stay tuned. We'll do this again next week on Thursday at 6 p.m. Central Time. So join us for that one, and we'll see you on the next call.